we starts the chapter number 4 of the security analysis and portfolio management, and the chapter number 4 is that is portfolio analysis and selections. So in this chapter, we understand in the last session that what is portfolio, how why the portfolio is important from the investor's point of view, and what is mean by diversifications. Okay, so that part we study in the last session. Okay, so in this sessions, we are going to understand that is how any investors can made a good portfolio. So for this purpose, there are this some of the scientists, or we can say the economists, who study on the portfolio and give some theories. So in this sessions, we understand the Markowitz portfolio selection model. Okay, how any investors can select such a type of portfolio. He made a good portfolio, and by this portfolio, he can get the good return, maximum return with the minimum risk. So, how any investor can do that? And next theory is that is the CAPM. Okay, so that is capital asset pricing model. So, okay, in this model, we understand the formula of the expected return. Okay, that is the return on assets. So, with this, we know the how the different diversified investments gives the return to the investors. So on that basis, we select the in diversified investment that is meant by the portfolio. So so in Mockovis, just a second, I'll share the screen with you guys. So in this session, so we're going to understand the Markowitz selection model. Okay, and the CAPM, that is capital asset pricing model. Okay, so uh, who is the Markowitz? Why the name of the theory is Markowitz portfolio selection model? So we can say the Markowitz is a great economist who gives this theory in 1952. That is, the Markowitz introduced the mean variance optimization, fundamentally changing the investment theory. So in 1952, that the Markowitz is an economist who analyzed that because we know that at the beginning of the 19th century, the industrial revolutions in West regions, that is the Western world, we see that many of the companies are formed in the Western region, like the Europe and the America. Okay, so we can say the listing of the companies started in between the 1945 to 1950. Okay, and that means the shares of the companies or the organizations were open for the investments. Okay, so so Markowitz is an American economist who study that how investors can maximize his return. He analyzed that if any investors invest his all his fund in one organizations, in one sector, in one industry, so it may he sees that so huge risks associated with such a type of investment. If that a particular company, that particular industry is not performing well, then in that conditions that it is possibility that the investor can lose all his funds. Okay. So what Markowitz analyze? So Markowitz analyze a past data, that is the past performance of the company and the past performance of the organizations. That is, we can say the financial performance of the organization. That is his revenue, profit. Okay, so all these things they analyze. All we can say the financial position, that is the liquidity position of the organization, solvency position of the organizations, and by analyzing all these, that uh, he gives a theory, that is the Markowitz theory. So in that theory, he actually what he did by using some, we can say, the tools of the analysis, like the correlation and the variance. Okay, so by using this, he conclude that okay, so he can tells by the mathematical correlations and the variance formula that this we can say shares or this type of investment gives the maximum return to the investments, or by applying the correlations and the variance to the past performance, past financial performance of the organizations, then investors select the optimum we can say the portfolio. The investors needs to only select the those investments avenues available to the investor which gives him or her a maximum return. So this is how the Markowitz gives his theory. So for this theory in 1990, Markowitz receives the Nobel Prize in Economics as well. Okay, so as we can say, if you see the Nobel Prize in Economics is given in 1990 to the Markowitz for this his contribution in the field of management. So we can say what is actually entails in this theory, that is the if we, why the needs of the portfolio. Okay, because the Markowitz analyze that if you go without the portfolio, that the huge risk is associated with the investment. So if the investor wants to take advantage of the each and every industry, okay, who is performing well, if the investor want to take the advantage of the different industries, different companies, okay, so then when it possible, when the investor diversify his investment. Okay, so that's why the Markowitz gives the theory on the portfolio optimizations. That is, first we for what we do a investment, for what the investor do the investment to get the maximum return. Okay, so no investor wants the minimum return. Every investor wants the maximum return. Okay, so we can say, so here one curve is given that if you see, if you analyze the some past financial data of the company, then you see over a period of time the trends or the pattern is we can analyze that. Okay, so we see in between okay, in the middle of the graph, the companies is performing well. Okay, so by doing such an analysis that we can maximize the return on the investments. Okay, so the curve represent the portfolio delivering the maximum return for each specific risk level. Okay, so in on y-axis we show the we can say risk on x-axis on x-axis we show the risk, and on y-axis we show the profit or the return level. Okay, so this is how we do the analysis with the help of the Markowitz model. Okay, so suboptimal portfolio. Why the portfolio, you can see, is important in the investment? The portfolios below the frontier are insufficient, so those above are mathematically unattainable. Okay, so if we fix the line, one line in between them, okay, those shares are representing the above that line, then we called it that that share is the gives the good return, and those shares are below that line that gives the uh, less return. Okay, so this is how we can say we plot the graph. Okay, so visual framework, in visual framework actually we see the risks on the x-axis and the return on the y-axis, and then we prepare the uh, correlations and variance graph, and on that basis we can conclude that uh, uh, which shares or assets or the investment is gives the you how returns. Okay, so the portfolio diversification, why is important? Reducing risks through the correlations. Actually, we use that mathematical tool, advanced mathematical tool in the Markowitz portfolio model theory. So Markowitz used the theory, and by using these correlations, he conclude that how a particular investors can make the good portfolio. So he used the correlation. So what is the benefits of the correlations? So combining the assets with the low or the negative correlation significantly lowers the overall portfolio risk. Okay, so we divide, we can say the assets into the two types. That is the low risk assets and the high risk assets. Okay, so by using this, so first we combine the assets with the uh, their risk type. That is the assets is the low risk type or the high risk type. Okay, so how we know that? By using the correlations, by applying the correlations on the past financial data of the organizations. So next one is the volatility smoothing. Okay, we know that the market is always, we can say there is always some risk is associated with your investments in the market. So that we call as the volatility. Um, so we can say the diversifications. Whenever we diversify the investment, that reduces the unsystematic risks, while systematic market risk remains the unavoidable. So first, you need to understand, guys, what is the difference between systematic risk and we can say the unsystematic risk. So we can say the unsystematic risk is the risks which we can avoid, and systematic risk which is unavoidable. That is which we cannot avoid. That means a systematic risk is such a type of risk uh, is in a control of the investor's hand. That means he can reduce that risk by selecting the optimum portfolio avenue. Okay, portfolio options available to the investors. That means by selecting the best option from the options available to the investors. Okay, that means we cannot choose such a type of industry, such a type of company in which, or such a type of country for the investment in which the risk is high. Okay, so we can reduce the unsystematic risks, but the systematic risks, which is out of control of the investors, we can say some of the type of risk which we can say the if any natural calamities happen, so definitely we will have the losses in the investment, but that risk is out of control of the investment, out of control of the investors. We can say we take the second example, that is if there is a political instability in any nations, so this risk is also a, we can say, out of control of the investors. So such a type of risk we called as the systematic risks. So systematic risks are the, we can say, such a type of risk which is out of control, which cannot be avoided while doing the investments. We can say some of the example, another example is the recession, depressions, okay, unemployment. So these are such a type of we can say the parameters which we cannot control. So this type of risk we call as the systematic risk, and unsystematic risk. We can manage this risk and reduce that risk. Okay, so the here one example uh, we take, that is the of the portfolio diversifications, how we do the correlation analysis. That is the stocks and bonds typically exhibits the low correlations, making them the ideal diversification partners. Okay, we know that what is the uh, relation between the risk and return. We know that it is a direct proportionate. Okay, so we correlate the risk. Okay, we calculate here the deviation, standard deviation, or we can see the variation, variance, and on that basis we calculate, we conclude the relation between the risk and return. We know that whenever we choose the high risk investment avenue, the risk associated with such a type of investment is high. Okay, so by using the past data, we calculate the we can say the standard deviation. If the standard deviation is high, So we called it as the risky investment. So we cannot go with the such a type of investments. So what we do in that Markowitz portfolio theory, we calculate the correlation. But so by using that mathematical tool, we select those investment options which is showing the uh, good correlation between the risk and return. So this is the concept in the Markowitz portfolio theory. So here in graph, if you see, so this is actually the graph of the Markowitz portfolio theory. On x-axis, we show the standard deviation. Okay, that is the correlation between the risk and return. Okay, on y-axis we show the expected return. Okay, so this is graph. We can say this is the concave curve. Okay, which actually tangent to the risk-free rate. Okay, so this is how we give the graphs in the Markowitz portfolio theory. So optimal portfolio selections on the efficient frontier. Okay, how one investors can select the optimum portfolio because he wants the maximum return with the minimum risk. So this is the main motive behind the investments. So the risk tolerance matching. So what Markowitz portfolio theory tells us, that is the risk tolerance matching. So what is the risk tolerance ability of the investors? Okay, on that basis how we made the optimum portfolio. Okay, so that solution is given to us by the Markowitz portfolio theory, that is investors select the portfolio along the frontier based on the invest individual risk references. We know that every individual investors has a different risk taking ability. So in last some sessions we see the two types of risk, that is the financial risk taking ability of the investors and the emotional or we can say the emotional risk taking ability of the investor. So that tolerance which is decided by the individual investor itself. So on that basis, actually, that we correlate the relation between the risk and return. On that risk taking, we can say the risk taking ability. On that basis, the investors select the different portfolio. Next one is the market portfolio concept. That is the by theoretical weighted combination of all the risk assets in the investment universe. Okay, so what are the different investment avenues or options available? So actually, we apply the weighted average combinations, and we identify all the risky, we can say the high risky, low risky investments options available. On that basis we take the decisions. Next one is the capital market line. The adding the risk free assets creates the CML, representing the optimal risk return combination. So in graph, if you see, there is one line is given to us, that is mm, that is a straight line. uh, if you see on the y-axis, okay, so mm, from y-axis the line is a straight line, we can say a upward sloping line. That means when you take we can say a zero risk, okay, then you get a that much return. Okay. Okay, so this is how, if you guys see, when we increases the risk, that is when we increases the standard deviation, your expected return gets increases because the graph is showing the graph is moving upward. If you see, okay, so this is how, when you take the zero risk, so this is the minimum return you get. When you increase the risk, that is we calculate risk with the help of the standard deviation by using the correlations. So when you increases your risk, automatically the expected returns also gets increases. So that we can say we calculate the capital market line. Okay, so at what risk, what return we get. Okay, so that we calculate in that Markowitz uh, portfolio management theory. Okay, so we can say the what is the limitation of the Markowitz model? Historical data dependency. We know that to calculate the standard deviation, to calculate the variance, the correlations, we need the some past financial data. So the heavy reliance on the past performance data. If we cannot say we cannot apply the Markowitz model theory to that company, which for which company the financial past financial data is not available. Okay, that means if the company is very new, that is the 1 or 2 year age. Okay, so we know that the 5 or 10 years data is not available because the company is very new. So in that case, we cannot apply the Markowitz, we can say, a model theory. So okay, so that theory is heavily we can say rely on the past financial data. So when the data is available, then and then only we calculate the standard deviation, and then we can say the future we can calculate the future correlations, what is the correlation between the risk and return, and on that basis the investors can take the decisions. Okay, next one is we can say the distribution assumption, that assumes the normal return distribution. The real market return often exhibits the skewness and the fat tails. Okay, so in a graph we see, so this is we assume that the at these when we take the zero risk, so how much return we get. So this is we can say we some of the assumptions actually we assume in the Markowitz we can say, while we can say calculate the correlations on the standard deviation on the variance, if we assume some assumptions. Okay, so it's heavily depend upon that assumptions. Okay, but in some of the cases that market is not follow that assumption, so in that case also we cannot apply this Markowitz portfolio model theory. Next one is the market friction ignorance. Completely ignores the transactions cost, taxes, beta spread, and the other real world market imperfections. Okay, that model theory completely ignores okay, so the tax costs, different cost. Okay, so they only we can say correlate the risks and return. Okay, so some of the other factors which is important from the investment point of view, like the bid. Okay, what is the minimum expectation of the seller, and what is the we can say what is the minimum price expectation of a buyer, and what is the maximum price expectation of the seller. So of all these factors is we can say is ignored while in the Markowitz portfolio management theory. Okay, so the nature is we can say a static nature. Markowitz model is not is a dynamic nature. It is a static nature because the single period model doesn't account for the dynamic rebalancing needs for changing the market conditions, because yeah, the Markov is not give a clear understanding of whenever the different market conditions. So how we differently calculate the correlations? Okay, because so it is only a single period model. Next one is crisis correlations. Okay, so the asset correlation spike during the market trace, undetermining diversifications uh, p- precisely when protection is most needed. Okay, so Markowitz gives that model theory for the normal market conditions, not for that such a type of condition, such a type of we can say some of the crisis conditions, some of the natural calamities. Okay, we can say some of the COVID-19 situations. So in that conditions, what one investor need to do, that not clearly tells by the Markowitz portfolio management theory. Okay, so this is we can say this is all about the Markowitz portfolio management theory. Here, some of the challenges is given to us, that is estimations error. Okay, so we can say who is calculating the standard deviation or the correlation between the risk and return. So okay, he can we can say if we do the errors while calculating that part, that we then the investor cannot take the good investment decisions. That is the estimation errors. That is the small errors in the expected returns and the covariance matrices can dramatically distort the optimization results. That means then investors can get the clear idea of the then he is not in position to select the different investment options with the maximum return and with the minimum risk. Next one is the over diversification risk. That is the excessive diversification may dilute the potential return without the proportionally reducing the risk. Okay, so if we uh, when we diversify the investments at the large scale, okay, so then we cannot take the advantage when the one of the particular company is performing very well, whenever the particular industry is performing a very good. That means we think we need to do a diversification, but at the once we can say at the little extent, not at the large extent. Okay, so over diversifications also we can say that hampered your returns. Okay, so these are the some of the real world challenges in the we can say the Markowitz portfolio theory. So we will you will have the better understanding. Okay, by some small graphical video. Okay, so then we you can clearly understand what is the Markowitz model.
Thing is a free lunch, and that especially applies to the world of finance. Everything is There's no such thing as a free lunch, and that especially applies to the world of finance. Everything is presented as a trade-off between risk and reward. But how can we quantify how much reward we should be getting for how much risk we are taking? And is there a way we can get the most amount of reward without taking too much risk? Well, in today's video, we're going to explore just that topic using the basics of modern portfolio theory. And hopefully, after watching today, you too will be able to balance your portfolio better to match your particular risk level. Maybe this will change your entire view on risk and how you go about making even basic life decisions. Now, and is there a way we can get the most amount of reward without taking too much risk? Well, in today's video, we're going to explore just that topic using the basics of modern portfolio theory. And hopefully, after watching today, you too will be able to balance your portfolio better to match your particular risk level. Maybe this will change your entire view on risk and how you go about making even basic life decisions. Now, as a warning, there is a little bit of math in today's video, but don't worry, we're going to make it as easy as possible. We will be also including an Excel sheet example in the description below. So when you're done with today's video, you can download the sheet and see how some of the math works for yourself. Also, feel free to use the sheet to help develop your own approach to portfolio management and investment. But a quick disclaimer, we're not suggesting that this is the best or only way to manage a portfolio, and there are many things you should consider with your financial advisor before investing. Now, without further ado, let's dive into the concepts surrounding modern portfolio theory. As a bit of history, modern portfolio theory, or MPT, was first detailed by Harry Markowitz. Markowitz theorized that everything should have a risk and return trade-off, and that this balancing act could be applied to any asset so long as there was an appropriate measure for risk. Markowitz suggested that an asset's volatility was a good metric to use to assess total risk. In other words, the more volatile an asset's price, the more risk this asset posed to an investor, and vice versa. If there was little volatility, then there was little risk posed to the investor. What Markowitz also noticed was that the riskier assets had the ability to pay off more than the less risky assets. However, riskier assets had a better possibility of losing more than less risky assets. And this is where the risk-reward payoff structure resides. For his work, Markowitz was given the Nobel Prize in Economics, which is probably the highest honor an economist can receive. So on to the math. Markowitz suggested the following. Assets move in correlated and uncorrelated ways to one another. Therefore, some assets would move together in a similar fashion, while others might move in dissimilar fashion, or even a negative fashion. Therefore, Markowitz believed that correlations and covariances between assets were important. He summarized this relationship in a covariance matrix we'll call sigma. Sigma can be thought of as a matrix made up of the time series covariances of each asset. Some assets will have higher covariances, while some will have lower covariances. But this still doesn't answer the question of how much of each asset you should have in your portfolio. What Markowitz also considered was that there was an infinite combination of allocations between assets a person could put into their portfolio. However, there was only a subset of combinations that he believed to be the efficient allocations. These efficient allocations lived along a curve, which Markowitz called the efficient frontier. Allocations which lived along this efficient frontier were considered to have the best reward for a given level of risk. So how do we calculate this curve using our covariance matrix? For this, we need to do a little more math. We know that we can have some set of portfolio weights for each of our assets. We will call this portfolio vector of weights W. If we multiply a vector of weights by our covariance matrix, multiplied again by the transpose of our vector weights, we get a volatility squared term. You can multiply any set of weights by sigma to arrive at your portfolio's volatility squared term.
This strategy can help you capture the biggest breakouts before they happen.
What we want to know is, when is this value minimized for a given level of returns? We will call this level of returns R. So how do we calculate R? Well, that's up to you. There are a few ways to do this, and we will discuss some ideas later on in this video. But let's just say for now that each of the assets we have calculated has an expected return value we believe is appropriate. We will put these return values into a new vector called mu. If we multiply mu by the transpose of our weights W, then we get a portfolio return of R. Multiplying by the transpose of our weights is the same as multiplying our expected return of each of the asset's portfolio weights and then summing them together. This is also known as a dot product. Now that we have our two equations, we want to minimize one and maximize the other. In other words, we want to minimize risk and maximize return. Because these two systems are consistent and undetermined, we get a curve as our solution. You can solve for any point on the curve using the equation W equals lambda times the inverse of sigma times mu. Lambda is your risk tolerance and ranges from 0, no risk, to infinity, unlimited risk. This has been quite a bit of math, and we don't expect you to understand necessarily all of it. What is important to understand is that we are trying to match off the risk-reward in the most efficient way possible. There are millions of combinations for portfolio, but there are only a few ways to get the allocation efficient, according to modern portfolio theory. Does it make sense to hold everything you own in Bitcoin? Or everything you own in Coca-Cola? Probably not. The reward of modern portfolio theory is that by diversifying in assets that have opposing correlations but positive expected returns, investors can theoretically maximize return and minimize risk. Speaking of Bitcoin, the concept of modern portfolio theory works for things like cryptocurrencies too. If you've ever thought about dabbling in cryptocurrency but don't know much about it or how much you should invest, then maybe you should look at modern portfolio theory and see if it gives you a better understanding as to where crypto belongs in your personal portfolio. Again, not every asset is right for every investor, but often by diversifying a portfolio across unrelated and uncorrelated assets, investors can add strength to their portfolios. We mentioned earlier in the video expected returns, so how exactly do we calculate that? Well, that's kind of a loaded question. The answer to this question is therefore tricky and varies from investor to investor. What matters is that you develop a working process for asset pricing and then apply that process universally when calculating your expected returns. Nobody can do this for you, and it really is the secret sauce behind a great portfolio investment strategy. But since you're watching, we weren't going to leave you completely in the dark. One way that many financial experts have used to calculate expected returns is related to some of the fundamental applications found in modern portfolio theory. We're talking about the CAPM method. CAPM stands for Capital Asset Pricing Model and has three components when calculating expected return. The formula states that your asset's expected return is equal to the risk-free rate plus the asset's beta times the expected market return minus the risk-free rate. The risk-free rate is the rate at which you can invest and receive a return on government.
So this is the that is the CAPM, that is capital asset pricing model. Is the next modern portfolio theory, which investor use while selecting the we can say the optimum portfolio to get the maximum return with the minimum risks. So in this formula, if you see the what every investors what is the main purpose why he is doing the investment, to get some expected returns. That is because we see that is every investor has the different expectation from his investment. He expect a return as per the he sets the goal, as per his objectives. We know that in investment process the first step investor must clearly stated or clearly we can say set, that is the uh, setting of a goal or the setting of the objectives. Okay, so as per his objective he's expected some returns, and for this purpose he doing the investment. Okay, so in this formula if you see, that is expected return is equal to RF plus B into RM minus RF. That means that RF is the risk free return. That means when you take zero risk, okay, so we'll get the some return on that investment. Okay, so that is we can say the risk free return. That means in that type of investment, your investment is a very safe, but you will receive the we can say less return. Okay, so when your expected return increases, okay, if you see in the equation, that is RF plus, okay, when the expected return increases, when your expected return we can say the things plus in your expected return, when you take the risk. So here beta, that is plus beta is the risk associated with the investment. Okay, so that beta represent the risk level, okay, of your investment. So beta into RM minus RF. So that RM is we can say the return maximum return in the market, and your RF is we already see that is the risk free return. So when you take some risks in your investments, so how you get the expected return? So by using this formula, first investor need to calculate the expected return. That is expected return is equal to RF plus beta, that means risk, into RM, that is the with by taking that risk, beta risk, how much maximum return you will get in the market. That is the RM. RM minus RF. Okay, so by using this formula, actually, we calculate, we can say the expected return on the different with the help of different investments, and then we choose the such a type of investments options, okay, that gives me the return as per my expectations. And by doing all these, we made the good portfolio. Okay.
T-bills. This is an easy number to find and is posted on the Federal Reserve website daily. The expected return of the market is what you anticipate the return of the market to be over some period of time. You can use historical returns to calculate this, or you can develop your own model to try and forecast market returns. It's entirely up to you how you approach this variable. Finally, there's beta. Beta is how much your asset varies against the market, or benchmark. Whatever you decide to use as the benchmark, it is important to remember that you will need to do it for the same asset class and that the relationship between your asset and the benchmark is appropriate. If you're trading bonds, then you shouldn't be using the S&P 500 as the benchmark. We won't be talking about beta in depth in this video, but we can summarize it as the covariance of the asset you're measuring and the benchmark. This is all over the variance of the benchmark. In future videos, we will dive into beta and show just how simple the term really is. Honestly, this equation looks a little frightening, but it's even more shockingly simple than you'd expect. We promise. So once you have all of these components, you can put them together into your equation and get an expected return which you can apply to your return vector mu, thus completing your understanding of modern portfolio theory. We hope that you enjoyed today's video and gained some insights into the risk-reward relationship. Again, this video does not constitute investment advice, and you should talk to your investment advisor about whether modern portfolio theory is right for you. Remember, past performance is not a guarantee of future returns. And as always, if you enjoyed today's video or learned something new, be sure to hit the like and subscribe buttons for more great content.
Okay, so here one practical example we are taking of this PM, that is the capital asset portfolio model. So in which we calculate the expected returns by using the different parameters. That is the beta. Okay, we can say the risk-free return or the market return. Okay, okay. So here some we can say the parameters are given, that is the stock with the beta, that is the 1.3, is we can say the you take that risk. Okay, so what is the risk free rate? That is the 3%. Okay, when your beta is 0, that is your risk is 0, then you will get the 3% return on the investment. That means when you invest the 100 rupees, okay, you will get the 3 rupees return on your investment after a 1 year. When you take a zero risk, that is when your beta is 0, then your amount will be after the 1 year is the 103. Okay, but when you take some risks, that is you take the risk of 1.3, and you expect, that is the when you take the risk beta, your expectation, that is you will get the expected return on that investment is the 8%. Okay, so what will be my expected return? So by using the CAPM formula, we calculate expected return is equal to RF plus beta into RM minus RF. So when you use that formula, so we'll get the actual value expected return, that is expected return is equal to 3% plus 1.3, that is the risk, is into 8% is the market return and the 3% is the free rate, then you will get the value of 3% plus 6.5% is the 9.5%. Okay. So when your beta is zero, when you take a zero risk, your return is only a 3%. That is, your 100 rupees will be 103 only when you take a zero risk. But when you take some risk, your your 100 rupees will be after 1 year will be a 109.5 rupees. Okay, so this is how we can say your expected return increases when you take some risk. So by taking the risks in the different investments avenue available or the investment options available to the investors, the investor takes the risks, okay, and he calculates the expected return on the different investment options available to him. Okay, so by analyzing all these, which are the best options, okay, so we can say he made the combinations of the risks and the expected returns. And by analyzing all these things, what is his objective, what he wants to achieve, what is his goals, accordingly he made his portfolio the and by using the CAPM model, that is the capital asset portfolio uh, model. Okay, so this is how we calculate the actual expected return by using the formula. Now, what are the practical applications of this model? So, this model is used for the asset pricing, cost of capital determination, and the portfolio performance evaluation. So, before doing the, we can say, before we can say doing the actual investments, you can calculate the expected return. So you will have the low losses and you can achieve the objective or goal by getting the expected return. Okay, so this is how we apply the CAPM model. But before applying this CAPM model, we can say we have to assume something. Okay, we have some assumptions before applying this model. That is the rational investor. That means all the invest are, we can say, are every rational. Okay, that means this investor are not the, we can say, the manipulated investors. These are the rational investors. That means they not prefer the any company, any industry over the another company or the another industry. They are natural, they are only thinking about their returns. Okay, so that investors we called as the rational investors. Okay, we can say next assumption is the frictionless market. So while doing the CAPM, we will not consider any taxes or the transaction cost or the other market frictions. Okay, so we can say that means we avoid that part. Okay, we cannot consider the impact of all these parameters while calculating the expected return. Okay, so this is assumption. That means we do not consider all this part, but actually these parameters having some impact on the expected returns. Okay, so unlimited borrowing, the investor can borrow and lend unlimited amount as at the risk free rate. Okay, so this is the mere assumption. Okay, so this you can say this is a ideal assumption. So this is not the actual things. Okay, the investors cannot always have the unlimited amounts with him. Okay, so this is the assumptions we are taking in the CAP model. We can say the homogeneous expectations. All the investors share the identical expectations. That means the investors having the only they wants is the expected return, the maximum expected return, good return with the minimum risk. Next one is the perfect competition. So the in perfect competitions, we know that already you guys learn that perfect competition in your subject economic analysis and business decisions. That is the number of n number of buyer and n number of sellers for that particular product. So in that case, we consider the markets are perfectly competitive. That means the n number of buyers for the investment is for the different shares, bonds is available, and the n number of investment option is available to the investor. So that's we assume in the CAPA model. Okay, so here we finished the two modern portfolio theory, that is the Markowitz portfolio theory and the CAPM theory. Okay, so if you have any questions, you can ask. or otherwise we sum up the sessions. It's already 6:59. Okay, so you can leave the sessions and join the other sessions. Thank you. Thank you, guys.